morning, everyone. We are the Group 1 and our topic is Understanding Financial Statements. Okay, first is what are financial statements? So, financial statements are written record that convey the business activities and the financial performance of a company. So, it means it is the financial dashboard of your business. So, it tells you where your money is going, where it is coming from, and how much you've got to work with. So also, it is the overall reports that summarize the important financial accounting information about your business. So in this chapter, uh, it provides a framework or several tools that help us analyze companies and value their securities. So next is how business activities are reported. So to be able to analyze a company effectively or its value, it is important that we must understand the business activities of the company. So we must understand the business activities of the company because this engage the primary purpose of making a profit. So business activities includes operating, investing, financing, and it is the term that encompasses all the economic activities carried out by the company during the course of business. So to accomplish this, we use the financial statements. Okay, so financial statements reports on a company's performance and financial conditions and reveal executive management's privileged information and insights. So this serves as the needs of different users because financial statements are presented in the structured manner with conventions accepted by a company and regulatory personnel. So next is operational of the accounting information systems involves application of accounting standards to produce financial statements. So accounting information systems helps to provide the insights on the business activities of the company or business under analysis. So accounting information should be used in the business context in which the information is created. So all the companies without exception plan business activities such as finance those activities, invest in those activities, and engage in operating activities. So the business firms conduct all these activities while confronting business forces, including markets, constraints, and competitive pressures. So financial statements also provide crucial input for strategic planning as well as information about the relative success of those plans. And also, this can be used to connective action and make new operating, investing, and financing decisions.
Good day everyone, my name is Nikki Jane Aragones and today I am going to discuss about the general objectives of financial statement. So we all know that financial statement is a very important thing in every business as they contain significant information about a company's financial health. This will help companies make informed decisions since they highlight which areas of the company provide the best return on investment. So now, let me discuss to you the four general objectives of the financial statement. First, financial statement is providing information for economic decisions. The economic decisions that are taken by the users of financial statement require an evaluation of the ability of an enterprise to generate cash and cash equivalents, and the timing and certainty of their generation. So economic decisions are made to serve the goods of individuals and private organizations and society as a whole. So financial statement will be implemented as a survey or monitor the enterprise how it's going. Financial statement can help to give information or improvements of an enterprise's how it's run, where we can see if it's expanding, how was the income is gaining to be for the past year. Financial statement will be used for income tax, where they can use as a cases of fees. It is a basic way of giving information to evaluate the accounts of the enterprises as a report of cash flows, availability of cash, where they can use to maintain and help the enterprises to go further movements and expansion so that it can be useful for the next generation till to the next generation, and help the local government by paying taxes and permits, and to help every laborers and individuals where it can provide for financial needs of their employees. So second, we have the financial statement is providing about financial position. So the financial position of an enterprise is affected by the economic resources, such as we have here letter A, information about the economic resources controlled by the enterprise and its capacity to modify these resources. So it just means that giving information about the economic resources where the enterprises give their ideas to show their capacity to maintain the resources, to show the ability of the enterprises to generate in the future. Letter B, information about financial is useful in predicting future borrowing needs and how future profits and cash flows will be distributed among those with our interest in the enterprises. Information on financial structure can be useful. Of course, this is to help individual who has a plan in enterprising, especially to the one who has interest in it. Okay. And letter C, information is useful in predicting how successful for enterprise is likely to be in raising further finance. Information is useful for the success of an enterprises in the future, how they raise their funds and financial supports of the enterprises to reach the plan of longer terms. So this is very important in the business. And lastly, the letter D, information about liquidity and solvency is useful in predicting the ability of the enterprise to meet the financial commitments as fall due. Liquidation is useful for the enterprises. Of course, this is to show its ability, to give information of the availability on cash, how it can be done, and provide the needs of the enterprises for the future to maintain for long-term operation after taking account of financial commitments. So let's move on to the third general objective of the financial statement. So providing information about performance of the enterprise. So this is the third general objectives of the financial statement. Another important objective of the financial statement is that it provides information about the performance and in particular its profitability, which is required in order to assess potential changes in the economic resources that are likely to control in future. It just means that financial statement is something that is a basis to know what is already the stand of an enterprise. If what it is going on, either it's gaining or is it losing, by this, they can use this to change the things that is needed to be changed to have a successful business. And lastly, the number 4, we have financial statement providing information about changes in financial position. The financial statements provide information concerning changes in the financial position of an enterprise, which is useful in order to assess its investing, financing, and operating activities during the reporting period. So this is very important, no? So that they can track whether they have a good investment. And by this, it will able them to know if they need to continue the way they use their finances, and this will help to operate the business smoothly and for your business to improve more. So That is all for my report. That is all about the general objectives of the financial statement. I hope you learned today. A good day and God bless. Thank you.
Good day, everyone. By the way, my name is Roma Jean Namarante, and today I'm going to discuss the demand for financial accounting information. So, decision makers and other stakeholders demand information in the company's past and prospective returns to facilitate efficient contracting. And there are broad classes of users that financial accounting information include the following. So, first, we have managers and employee. For their own well-being and prospective earnings, potential managers and employees need accounting information on the financial condition, profitability, and prospects of their companies, as well as comparative financial information. So meaning, managers and employees use financial information to confirm the past results and help to make adjustments for future activities. Second, management uses financial statements to raise financing company to meet disclosure requirements and to ensure as a basis for executive remuneration and bonuses. So meaning, management requires regulatory accounting information for the effective monitoring and control of the organization's financial matters. Managers also rely on accounting information for financial planning and decision making. So third, managers demand financial accounting information to help them carry out their responsibilities to shareholders. On the other hand, employees demand financial accounting information to monitor payouts from profit-sharing plans and employee stock ownership plans. So meaning, managers and employees requires accounting information for their work organization for personal and professional reasons. Managers exist at different levels of an organization. They are the one to manage people in a leadership role or managing projects and tasks. On the other hand, employees need accounting information for assessing their job security as well as the performance of work-related tasks. So second, we have investors and analysis. Financial statements are used by these parties to decide whether to buy or sell equity shares. Expectations about future profitability and the ability to generate cash influence the price of securities in a company's ability to borrow money at favorable terms. So meaning, investors and analysts use financial statements to obtain valuable information. This information makes it important to understand how business accounting is done and which principles guide financial statements preparation. An analysis provides services from producing summary reports and recommendations about companies to actively manage for investors that prepare to buying and selling decisions. And it helps for the investors to determine assets value, understand the company's financing sources, and calculate profitability. And third, we have creditor and suppliers. Banks and other lenders need financial accounting information to help determine loan terms, loan amounts, interest rates, and required collateral. Meaning, the bank and lenders use financial information to make decisions. This decision will make whether the funds will be repaid by the borrowers. So this is the reason why this is important because lending money involves risk. As a rule, the longer the money is borrowed, the higher the risk involved. The second, suppliers demand financial data to establish credit terms and to determine their long-term commitment to supply chain relations. So meaning, suppliers use the financial assessment similarly to banks and lenders to assess risk and creditworthiness. Before a supplier open a line of credit, they want to ensure that the company has a healthy financial situation. So for example, they need to know if the company they sell their goods is having trouble paying its bill or may even be at risk of going under. So, fourth, shareholders and directors. Financial accounting information is needed by owners and directors of the company to assess its probability and risk to evaluate managerial performance and to help make leadership decisions. So meaning, shareholders use financial accounting information to decide business matters, whether a particular management compensation plan should be approved, and if the company should merge with or acquire another company. On the other hand, the director will be the one to assess how management has discharged its responsibility for protecting and managing the company's resources, shaping decisions about when to borrow or invest company resources. So fifth, we have regulatory and tax agencies. The SEC, BIR, BSP, and other legal institutional demand need financial accounting information to monitor the business firm's compliance with laws for public protection and other regulatory policies. Meaning, the SEC, BIR, and BSP is controlled and conducted by authority which involves setting standards for disclosure in the financial. They are the one to provide adequate and mechanism to monitor the standards that required in the financial reporting. On the other hand, taxing authorities or tax agencies use financial accounting information as a basis for establishing tax policies. Companies or industries that appear to be earning excessive profit may be targeted for special taxes or higher tax rates. 6 is customers and potential strategic partner. Customers, both current and potential, need accounting information to evaluate companies' ability to provide products and services as agreed to assist the company's reliability and staying power. So, meaning they need accounting information to assist the financial performance and positions and to have a responsibility assurance that the business to whom they are going to lend money would be able to return the principal amount as well as pay interest their own. So we have 7. Other decision makers. Financial accounting information are required for varied purposes for other parties, from assessing damages for environmental abuses to making policy decisions involving economics, social taxation, and other initiatives. So to sum up, financial accounting plays a key role that allows businesses to keep track of all their financial transactions. It is the process in which companies record and report the pieces of financial data that go in and go out of its business operations. So these transactions are potential in financial reports that provide an insight into a company's activities and financial positions. So that could be all. Thank you.
Good morning, everyone. Let's proceed to the sources of information and business enterprise. So the business information comes in general surveys, data, articles, books, references, search engines, and internal records that a business can use to guide its planning, operations, and the evaluation of its activities. So in general, the quantity and quality of accounting information that companies supply are determined by the manager's assessment of the benefits and costs of disclosure. So in the Philippines, publicly listed companies must file financial accounting information with the Securities and Exchange Commission. So first, is the audited annual report that includes the four financial statements. So these are the statement of financial position, which is traditionally known as the balance sheet statement, then the statement of comprehensive income, statement of stockholders' equity, statement of cash flow. So the unaudited quarterly or interim reports that include summary version of the four financial statements and limited additional disclosure. So intelligence helps managers anticipate the legal and political changes. So this could help them monitor economic conditions in the country and abroad. So all other registered corporations and partnerships are likewise required to file annually audited financial statements with accompanying explanatory notes with the SEC or the Securities Exchange Commission. So let's proceed to the third slide, which is the benefits of disclosure. So before we proceed, disclosure is the process of making facts or information known to the public. Proper disclosure by corporations is the act of making its customers, investors, and any people involved in doing business with the company aware of pertinent information. So disclosures are at the center of the public's crisis of confidence when it comes to the corporate world. So they should be viewed as a very important and informative part of doing business with or investing in a company. So let's proceed to the fourth slide. So the advantages of supplying accounting information extend to a company's labor, capital, input, and output markets. So the corporations issue disclosures to provide investors and investment analysts with information that could influence an investor's decision. This could be whether to buy a company's stocks or bonds. So the debt and equity financing are sourced from capital markets, and the better a company's prospects, the lower will be its cost of capital as reflected in higher stocks prices or the lower interest rate. So the company's ability to disclose reliable or the audited accounting information about its products, processes, and other business activities enable them to better compete in capital, labor, input, and output markets. So the disclosure statement can reveal negative or positive news and financial information about the company. So next is the cost of disclosure. So according to Diamond of 1985, shows that disclosing information reduces the need for each individual shareholder to bear the cost of gathering it. So let's proceed to the last slide. So the cost of disclosure has the preparation and dissemination of costs of supplying accounting information that can be substantial, and the possibility for information to produce competitive disadvantages is high. So this could harm their competitive advantages. So companies are apprehensive that disclosures of their activities such as product or segment successes or failures, strategic initiatives, technological or systems innovations could harm their competitive advantages. So companies also face possible lawsuits when disclosures create expectations that eventually are not met. So disclosure costs, including political costs, are high for highly visible companies such as large telecommunications conglomerates such as PLDT and Digital. So the oil companies and software companies, because they are the favorite targets of public scrutiny. So the costs of disclosure have been more difficult to pin down. So first is that the actual act of communicating information may be costly. Second, there may be costs of producing information. However, firms already produce copious information for internal and tax purposes. So the third one is that the information may be proprietary, or for an example, business sensitive, and disclosing it will benefit competitors. So that's all for the three topics. So next is the constraints on relevant and reliable information.
Hello everyone, good day. Today, I'm going to discuss the continuation of our report, which is constraint on relevant and reliable information. But before that, let me introduce myself first. I am Jairine Abrasaldo, so let's start. Constraint on relevant and reliable information. Constraint means factor that may affect the relevance and reliability of financial information. So, in financial statement, there might be constraints that are present. Now, I will discuss the four constraints on relevant and reliable for the user. First is timeliness. Management may need to balance the relative merits of timely reporting and the provision of reliable information. If there is an expected publication in reporting the financial information of an entity, then the information itself may not be relevant or reliable for the users. Next is balance between benefit and cost. The benefits derived from information should exceed the cost of providing it. If costs are more than the benefits, then an entity may decide not to provide the financial information which are difficult to obtain. The third one is balance between qualitative characteristics. The aim of financial statement is to achieve an appropriate balance among the characteristics in order to meet the objective of financial statement. In some cases, conflict may happen between the characteristics. Therefore, a trade-off may happen to allow the objective of financial statement to achieve. The last one is true and fair view or fair presentation. Financial statements are frequently described as showing a true and fair view of or as presenting fairly the financial position, performance, and changes in financial position of an entity. The framework for presentation and preparation of the financial statement does not mention how an entity should present the characteristics fairly. So it is part of the constraint on relevant and reliable information. So that's the end of my report.
So now let's move on to linkage of financial statements. So the four financial statements are linked with each other and linked across time. So what are the four financial statements? They are the balance sheet, income statement, cash flow statements, and statement of shareholders' equity. So this linkage is also known as the articulation. So the statement of financial position and statement of comprehensive income are linked to each other via retained earnings. Then, retained earnings are updated each period and reflect cumulative income that has not been distributed to shareholders. Next slide would be the order of financial statement preparation. So the first one is the preparation of income statement using the statement of comprehensive income accounts. So the statement of comprehensive income refers to the statement which contains the details of the revenue, income, expenses, or loss of the company that is not realized when a company prepares the financial statements of the accounting period, and the same is presented after net income on the company's income statement. And the second one would be the preparation of the statement of financial position using the updated retained earnings account. So retained earnings, by the way, is the amount of net income left over the business after it has been paid out its dividends to its shareholders. Next is preparation of statement of shareholders' equity. Then lastly, we have the preparation of statement of cash flows. Next slide. So in this picture shown in this slide is the example of statement of financial position, statement of cash flows, statement of comprehensive income, and statement of stockholders' equity. This time, let's talk about the statement of financial position. So, reports a company's financial position at a point in time. It is the listing of the resources that an enterprise has to operate with, as well as the listing of claims against those resources represented by both creditors and owners. And also, we have the ways of financing assets. There are basically two. So the first one is owner financing, which can raise money from shareholders. And on the other hand, non-owner financing can raise money from banks or other creditor and suppliers. So this basically means that both owners and non-owners hold claims on company assets. Owner claims on assets referred to as the equity, and non-owner claims are referred to as the liability or the debt. So since all financing must be invested in something, we can obtain the following basic relation, which is investing equate to financing. Now here, let me define to you what asset is. So assets are resources controlled by an entity as a result of past event from which future economic benefit are expected to flow to the entity. For example, or let me have some examples of assets. The first one is cash and cash equivalents, which are example, treasury bills, certificates of deposits, and then cash. And next asset would be marketable securities, which are debt securities or equity that is liquid. Then also we have the accounts receivables. So accounts receivables are money owed by the customer to be paid in a short term. Then we also have the inventory as a part of the assets, which are goods available for the sale of raw materials. Then also the definition of liability. So liabilities present obligation of an entity arising from past events. So just like, for example, bank debt, mortgage debt, money owed to suppliers or the accounts payable, wages owed, and taxes owed. And lastly, we have the equity, owner's claim on assets. So equity is the ownership of any asset after any liability associated with the asset are cleared. So for example, let me state to you some example. So if you own a car which worth $25,000, but you owe $10,000 on that vehicle, the car represents $15,000 equity. So it is the value or the interest of most junior class of investors in assets. So as what I've said earlier, investment equates financing. Then we also have the next slide, which shows to you an example of statement of financial position. So we have here the first one, the date, that is the report amounts at a point in time, which is December 31, 2011. Next would be investing, which refers to as the assets. So in assets, we can see here cash and non-cash assets amounting to 88,658 and 457,662. Next is the total resources or the total assets, which is the sum of cash and non-cash, in this example amounting to 546,320. Then we have the financing, which is the liability and owner's equity. Then we have non-owner claim on resources, which is the total liabilities amounting to 299,518, and then owner claim on resources, which is the total owner's equity amounting to 246,802. Next slide is investing activities. So it is represented by the company's asset, meaning statement of financial position is organized like the accounting equation. Investing activities are represented by the company's assets. These assets are financed by a combination of non-owner financing and owner financing. We also have the financing activities, which involve long-term liabilities, stockholders' equity, or the owner's equity, and changes to short-term. So for example, the meaning of which is assets must be paid for, and funding is provided by a combination of owner and non-owner financing. Owner financing includes resources contributed to the company by its owners along with any profit retained by the company. Non-owner financing is borrowed money. Then the working capital. So the working capital is the difference between the current asset and the current liability. So current assets are often called the working capital because these assets turn over, that is, they are used and then replaced throughout the year. Then net operating working capital is the difference between current assets and non-interest bearing current liabilities. So basically that's all with my report. So let's move on to the next reporter. Thank you.
Financial statements. So these are the reports that provide detail of the company's or entity's financial information, including assets, liabilities, expenses, income, and other related detail that the companies had during the period of time. And now, I will going to discuss the rest of the 4 financial reports, including Statement of Comprehensive Income, Statement of Stockholders' Equity, and Statement of Cash Flows, including the operating activities. First, we have Statement of Comprehensive Income. The Statement of Comprehensive Income reports on a company's performance over a period of time, at least amount of revenues, also called sales, expenses, and other comprehensive income. Revenues less expenses yield the bottom line net income amount. So basically, it summarizes both standard net income and other comprehensive income, or what we call OCI. So the example given there is the Statement of Comprehensive Income of Blue Company. We have the revenue, then it could be deducted with the expenses, and the total amount of it is what we call the net income. And if there are other comprehensive income, it should be added to the net income, and that would be the total of all the comprehensive income. Net income reflects the profit, or what we call earnings, to owners for that specific period of time. In merchandising firm, in their equation, it is different from a single-step income statement because it is more detailed statement and it is expanded than the single-step income statement. It includes the cost of goods sold. Cost of goods sold refers to the direct cost of producing a goods sold by a company. Please refer to the given formula. Next, we have operating activities. So this is one of the classification of cash flows. Actually, there are 3 classification of cash flows, including operating activities. Second is investing activities, and third is financing activities. In operating activities, there are 2 markets, the inflows and outflows. Cash inflow is the money going into the business, and it is opposite from the cash outflow. So it could be from the sales, investment, or financing. Now, if the cash inflow is greater than the cash outflow, then the business is considered healthy. Some examples of cash inflows are the cash receipts from the sales of goods and services and cash receipts from the collection of accounts receivables. While opposite to the inflows, cash outflows examples are the cash payments of suppliers, cash payments of employees, and other cash payments that the company is going to pay. From the given example, the total net income would be added by the adjustments of cash provided by operating activities, and the total would be 297,000 pesos, and that would be the net cash provided by operating activities. Next is statement of stockholders' equity, or it is also called statement of shareholders' equity. I guess this is the same with statement of changes in equity. Basically, it is an account on a company's balance sheet that consists of share capital plus retained earnings. The statement of stockholders' equity reports on changes in key types of equity over a period of time. For each type of equity, the statement reports the beginning balance, a summary of the activity in the account during the year, and the ending balance. From the sample given from Blue Company Statement of Stockholders' Equity, we have to compute the total of the activity during the beginning of the year, and the total of it all would be the ending balance of the year. It shows the total amount of capital attributable to the owners of the business. Detailed earnings, these are the total portion of earnings that left with the company after the distribution of dividends to the shareholders, including the sales revenue or cost of goods sold. Next, we have the last portion of the financial statement, which is a statement of cash flow. So it summarizes the cash and cash equivalents that entering and leaving the company. The statement of cash flows measures how well the company generates cash and how well they manage their cash position. The statement of cash flows includes three activities. First, the operating activities, second, the investing activities, and the last one is the financing activities. Now, the total amount of the operating activities would be deducted to the investing activities, total amount of it, and add by the financing activities. And the total amount of the all activities would be add if they had the cash of the beginning of the year, and it would be the total amount of it would be the cash balance in the end of the period. From the sample given of Blue Company Statement of Cash Flows, the operating cash flows is added by the financing cash flows and deducted by investing cash flows. The net income would be 586 and added by the beginning of the year, and the total would be the ending balance of the year, 44,329 pesos. In bookkeeping entry, this would be the actual layout of statement of cash flows, so it is more expanded than the last one. As you can see, all accounts from the operating activities, from investing activities, and from financing activities are shown in there, and as well as the details of each transaction, the total of each accounts are shown in there. I am Marcela Alejo, and that would be the end of my discussion.